Hello, everyone. Thank you for joining us today and taking the time to learn more about taxes in retirement. Before we get started, I have a couple of housekeeping items to go over. If you have any questions during today's presentation, please feel free to type them into the chat section you'll find if you look over to the right-hand side of your screen. Only your presenter, Peter Hafner, will be able to view your questions. Peter will answer your questions at the end of the webinar via email. One thing you'll notice about Peter is that he is an educator at heart. Today, he's going to share with you proven strategies and explain to you why they work using relevant examples and easy to understand illustrations. His knowledge comes from more than 30 years of experience in the financial planning industry. After working for A.G. Edwards for over 14 years, he founded the Hafner Financial Group in 2007 to focus primarily on retirement income planning. This is the Hafner Financial Group specialty, transitioning you from the working world into the retirement you've dreamed of. Peter and his team have helped hundreds of clients do just that. I would also like to mention that we are going to discuss a number of tax strategies today, but we do encourage you to consult with a qualified tax professional to discuss your unique situation before making any changes. And now, would you please help me welcome Peter Hafner?
All right. Thanks, Sam, for that nice introduction. I appreciate that. And is my camera working? Can you see me, Sam? Is that working okay?
Yes, you're working great.
All right, great. All right. So thanks for joining me, everybody. And before we get started, I just want to talk about something, because there's a reason we're here today. And it's something that didn't exist for our parents. Retirement planning today is really different than it used to be for prior generations. So, what I want to do is I want to talk to you about something that happened 51 years ago, and it changed the game for millions of Americans when it came to retirement. And that's way back in 1974. You all remember what was going on in 1974? We were probably pretty little, but we remember some stuff, right? Godfather Part 2 was out, Blazing Saddles. Somehow I saw Blazing Saddles, and I wasn't even 10 years old. But new products that came out were Post-it notes and Skittles. And can you imagine a world without barcodes? But it was only a few years ago they didn't exist. President Nixon, he was out, Ford was in, Leonard Skinner was hot, and so was ABBA. And then something else changed in 1974, and it was called ERISA. And you've probably heard the term ERISA. ERISA stands for the Employment Retirement Income Security Act. And the reason ERISA was created was because there were a bunch of pensions that were failing. If you think about our area, there was like Bethlehem Steel was having a lot of trouble, and people were losing their pensions. They were losing their retirement livelihood, basically. So what ERISA did is it was enacted by Congress, and it was a way to maybe protect people in the future. So they had more control over their retirement assets than they had in a pension system. But what it also did is it shifted the responsibility from the corporation to the individual, right? You had control, but now you also had responsibility. It's almost like you got to be your own pension manager today. And some of the tools you've got to be your own pension manager were created with ERISA. They were IRAs, 401ks, 403bs, and all these different kinds of tax deferred accounts that you see here. So that's what happened in 1974. And the belief was that people would be able to save for their own retirement, take some of the money they earn, put it away in these tax deferred accounts, and they would get a tax deduction while they were working in their higher earning years. And the hope was that when they retired, taxes would be lower. And mostly that's the way it worked for most Americans. And because of this, because of these tax incentives, ERISA assets have ballooned, skyrocketed to over $40 trillion now. So this seems like it's really good news, right? And I guess it is, but there's sort of a shadow aspect to this. Tax deferred was a brilliant concept for us, but it's also good for the government and the IRS too. And why is that? It's because they need our money, right? We have a budget deficit today that's about $1.8 trillion. And what a budget deficit means is that the government is spending about $1.8 trillion more than they're bringing in every year. And of course, if you spend more than you bring in, you know what happens, right? You know what happens in your own household. You're going to add to your debt, and your debt is going to keep going up. And what this chart shows is the end of 24, the the fiscal debt was 35 trillion. I just looked it up before the workshop this morning, and today it's 38 trillion. So it's already up quite a bit more since the end of 24 over the course of 2025. So what does this all mean? Well, what it means is the IRS needs money, the government needs money, and we retirees or people who are quickly approaching retirement, they got the money. Okay. They got enough to cover the entire debt. And so for the first time in 51 years, it could be, it's not certain, but it could be that taxes will be going up after we retire. And I got to tell you, over my entire working life, and I've been doing this about 35 years now, all I've seen really is federal taxes going down over our lifetimes. The state taxes have gone down, brackets have gone down, but it could be that things are going to change because the debt and the deficit are just so large. And it's not just taxes, it could be fees on programs like Medicare and Medicaid. Um, it could be reduced Social Security benefits. There could be lower thresholds for taxation. There could be changes to inheritance rules. And any of you hear this? This has already happened. Okay, just in the last couple of years, the inheritance rules have changed. It was done through the Secure Act. What they did is if you inherited an IRA, you used to be able to stretch the distributions out over your lifetime. So you could take out the smallest amounts year by year. And of course, if you're taking out a little bit of money, you're paying less in taxes. But what they did is they compressed the time frame from your lifetime to just 10 years. And because of that, you got to take out more money every year. And if you're taking out more money every year, you're going to pay more tax every year. So this is one way that what I'm saying, the government needs money to cover the debt, that it's already happening. And this is in part why you need to have a well thought out plan when it comes to taxes and retirement. Having a well thought out plan will help you avoid costly mistakes so you pay less in retirement and you're able to keep more of your own money. It's not what you make, it's what you keep. And you've got to have a plan and a strategy, preferably a written plan, so that you can keep more of your own money. And that's why I'm glad you're here today, because what we're going to cover today, by the time you're done today, you're going to know what the major tax challenges are as you enter retirement. You're going to have an understanding of how to create solutions that address these challenges. And I believe that by the time you're done today, you're going to feel relieved because you have strategies designed to help you keep more of your own money. And how are we going to do that? We're going to cover three key points. The first of which is you have to know what your after-tax retirement savings picture looks like, preferably before you retire, because it's not as much as it seems. Number two, we're going to look at Social Security and Medicare because they have their own tax traps. And I want to show you how to plan for them too and keep more of your own money. Then number three, you've got to have a plan for when and how you're going to use taxable, tax deferred, and tax-free assets in an attempt to keep your tax brackets lower so that you can spend your money more efficiently when it comes to taxes. And we're going to cover all these different topics before we're done today in about the next 50 minutes. And one last thing, we're going to keep this completely educational. I know a lot of these workshops, people are trying to sell you stuff, but we're really not. And when I say that, though, I know some of you are skeptical, and maybe some of you ladies are holding on to your purse. I hope not. But anyway, there's three reasons why I do these free educational workshops every month, and we do a couple of them every month. First is it helps me to stay sharp and stay on top of the changing rules, strategies, and taxes. And that's good for me, it's good for my clients, and it's good for you. That's why it's good for me to do these workshops. Number two, it's a way for me to give back to the community. This is really important to me because I'm part of the community. I was born in Buffalo. Actually, I was born in Tonawanda, but I grew up in Cheektowaga. I'm a graduate of Cheektowaga Central, class of 1984, and I'm a graduate of the University of Buffalo. So I'm a product of Buffalo, Cheektowaga, and Western New York. And we here at the Hafner Financial Group, we really understand your unique needs and concerns, unlike someone in some call center far, far away. And the final reason, the third reason we do these workshops all the time is because we do find that when people come here, they come here for a reason. And the reason is they've got questions and they're not getting the answers from the usual sources. And we also find that a fair number of people who meet us through these free educational workshops, they ultimately choose to work with us in their financial planning and retirement planning. So that's why we do these workshops. And now we're just going to jump right in and get started. So once we get to retirement and how it relates to taxes, it's like a whole new world. Everything's different. Everything's new. Um, when we're working, we're in the accumulation phase. We're saving instead of spending. And when it comes to taxes, basically our employers are taking care of a lot of our tax burden, right? The employer is withholding taxes from our income. And that's where most of our tax burden comes from, is our income. And then we file a tax return with the help of a CPA or tax preparer. And that's really it when it comes to taxes. But once we retire, we generally don't have the child tax credit anymore. You can't deduct your interest because most of us are using the standard deduction. Health insurance changes. We're not contributing to a 401k anymore. So a lot of things we used to have are gone. And then there's all this new stuff like Social Security and required minimum distributions. We've got to pay for Medicare and maybe for long-term care insurance. So there's all these new things we need to be aware of and think of, and we've got to integrate them into our retirement plan. And again, it's not what you make, it's what you keep. So you got to be really careful about how everything's taxed so you can keep more of your own money. So the first of the three keys we're going to talk about is how do you know what your after-tax retirement picture looks like? And you want to know this before you retire. And what I mean by this is, you get your statements in the mail, right? And you got a pie chart on them and they show you how much money you got. So if you add up your 401ks and your IRAs and your other retirement savings account, maybe you got $500,000. And that's great. But you need to understand the $500,000 in your 401ks and IRAs, it is not worth $500,000. And that sounds crazy, right? But it is not. And the reason it's not is because you've got a silent partner in your 401ks and IRAs. It's the IRS, it's the US government. If you've got $500,000 and you're in the 35% tax bracket, by the time you pay all your taxes, you can only spend $325. That is a big hit to your retirement savings, right? You cannot spend $500,000. And if you take out too much too fast, you might even make your Medicare premiums more expensive, and then you keep even less of your own money. And if you're in higher tax brackets, you've got even less money. So what it looks like you've got to spend is not what you've actually got to spend. It's really important. And some people say, well, I got a trick for that because I got a pension and I got Social Security and I don't need that much money. I'm just going to leave the money in my IRA. That way I won't get taxed on it. Well, you can try that, but what's going to happen is there's something called required minimum distributions. Okay. And they're going to force you to take money out of your IRAs at some point in time. So if you're born in 1960 or later, once you're 75, they're going to force you to start taking money out of your IRA and 401k. And the reason they force you to do this is so they can tax it. That's what it's all about. If you were born prior to 1960, the age for you is 73. It's going to come up faster. And how many of you have gotten a projection to show how large or small your required minimum distributions are going to be? If you haven't done this, you really need to do it because RMDs, once you get to that age, that extra money coming out of your investments that's taxed, it can push you into higher tax brackets and it can make your Medicare premiums more expensive. So you need to be looking at this. So the first key, it's really important. Your retirement accounts are not worth as much as you think. And the higher your tax brackets are, the less purchasing power you've actually got. So what some people think at this point is, well, at least I got my Social Security and my Medicare. That's going to help me out, right? And that's true. But key number two is all about the tax traps and penalties you might pay if you don't apply for Social Security or Medicare at the appropriate times, if you don't handle them properly. Now, we're going to look at both of them. We're going to look at Social Security first. And when it comes to Social Security, there's three things I want to cover. One's good, one's bad, and one's kind of ugly. So we'll talk about the good thing first, and that has to do with working in Social Security. And one of the good things about working in Social Security, well, you need to understand how Social Security benefits are calculated. And the way it's calculated is they look at your highest 35 years of income. And if you look at your Social Security statement, it's going to show you all your years, all the income you've earned. Okay. What you want to focus on is the highest 35 years, because that's what they use to calculate your benefit. Now, sometimes people have zeros in those 35 years. And unfortunately, this especially happens to women. And women know why, right? It's because they stay home to take care of kids. They're the ones who are often taking care of elderly family members, and they sometimes have low years of earning or no earnings for some years. So what women can do, even if you've already claimed Social Security, if you keep on working and you've got zeros for those 35 years, if you keep on working and claim Social Security, those zeros will be removed and your Social Security will be adjusted upward. Okay. So you want to, if it works for you, that's something you can do to increase what you get out of Social Security. All right. Now, Social Security in the bad. This has to do with if you're working in Social Security and you're not at full retirement age yet. Once you're full retirement age, which is 67 if you're born in 1960 or later, it's 66 in some number of months if you're born prior to 1960. But if you earn over a certain amount of money, they're going to take back some of your Social Security benefit if you're earning too much prior to full retirement age. And that magic number in 2025 is $23,400. Okay. So if you're claiming Social Security, not full retirement age, and earning less than that, no problem, nothing to worry about. But if you've claimed Social Security prior to full retirement age and you earn over $23,400, they're going to take back $1 of Social Security benefits for every $2 you earn over $23,400 in 25. Now, this goes up every year, so you'll want to check and see where it's at once we get into 26. And even though they withhold this money, it's not the end of the world. I mean, if you're surprised and your Social Security benefit goes down, that's not good. That's why we labeled this bad. But what they do is once you get to full retirement age, all that money they took away from you, they recalculate your Social Security and add it back in. So you'll get a bump up when you get to 66 or 67, depending on full retirement age. Okay. Now, working, Social Security, and the ugliest part. So you still pay Social Security taxes even when you work in retirement, even if you're receiving benefits. Okay. It doesn't matter full retirement age or not. If you're working, you're going to pay into the Social Security system. You're going to pay Social Security tax, even if you've already claimed benefits. And if you're self-employed like I am, you're going to pay twice as much because you got to pay for Medicare. So it's 7.65% for you folks. even if you're already claiming Social Security. Now, one of the good things about it is it could increase your Social Security benefit if you're at your peak earning years and you're knocking off some lower earnings in your 35-year record. So that's one silver lining here. But mostly what I want you to know is you are going to keep paying Social Security tax, even if you've already claimed Social Security. So that's Social Security and taxes or the different kinds of fees we pay. Now let's look at Medicare. And with Medicare, it's not so much taxes, it's really fees. So let's start with this. We're going to talk about the IRMAA cliff, okay? And IRMAA stands for Income Related Monthly Adjustment Amounts. And this is something that is looked at every year to determine how much you pay in Medicare premiums. So, did you guys know that Medicare can be more expensive if your earnings are higher? It can be. And people can get into trouble with this because sometimes, well, I'll come back to this later. But let's look at an example. Here we've got Dave and Irma. We're calling them the Cliffs. And they've got Medicare Parts B and D, and their modified adjusted gross income is $334,000 in 23. So there's a couple of things I want to talk about here. Modified adjusted gross income is what the IRS uses to determine how much you're going to pay for Medicare. But for almost all of you, your modified adjusted gross income is equal to your adjusted gross income. Okay. So just focus on that. Their modified adjusted gross income in 23, this is 25. Okay. This is not a typo. Their modified adjusted gross income in 23 was 334. The reason we're looking back 2 years is because that's what the IRS uses to determine what your income was for Medicare this year. They're always looking back 2 years. Now, their modified adjusted gross income in this example was $334,000. But then Irma and Dave, they decide to sell a stock for $1,000 gain. So they got to pay capital gains on this, right? And in fact, not only do they have to pay capital gains on it, they also got to pay the net investment income surtax because their income is high enough. And we don't get lost in the details here. The main thing you need to understand is that in addition to the 334 adjusted gross income, they chose to sell a stock, which resulted in tax of another $188. Pretty small potatoes, right? $188 compared to 334 is a rounding error. It's nothing. But look what happens. This is what I was talking about with here's the IRMAA Cliffs. This is the way it works. So married filing jointly. Okay. If your income is 212 or less, you would have paid 185 for your Medicare in 2025. But this couple, their modified adjusted gross income was 334. So they'd be paying 370 a month each. But they were right at the edge of 334. Remember? They were 334 and then they generated another $188. And it doesn't matter if you're over a little or over a lot. If you go over that 334 cliff, that IRMAA cliff, you're in the next bracket. Okay. And that's what happened to them. They went over by just a little bit of money, but now they're going to pay 480 per month each for Medicare. Not today, because they did this in 25, but in 27, when the IRS sees what they did when they're looking, they're going to see their Medicare premiums go up. So they're going to pay an extra $295 each per month. That's how much that costs them. So this is why you need a well thought out plan, because their baseline put them right at the top of the Medicare IRMAA brackets, and then they decided to sell the stock. Did they have to sell the stock? I don't know, but if they didn't, they might have made a bad decision here. Okay. And it's not just Part B, it's also Part D. Their Part D is going up also $57. Well, not 57, 35 to 57, whatever that is. So it's going up also. And ultimately, this is really expensive. You know, it winds up costing them an extra $3,370 If you add in the Medicare premiums, as well, the increased Medicare premiums, as well as the capital gains tax and the net income tax. So when we're thinking about taxes in retirement, there can be many, many unintended consequences to things we think we understand, right? I mean, we think what's going to happen. We're going to pay an extra $188, but that's not always the way it works. And this is why you need a well thought out plan because the tax code is not intuitive. And it's really easy to make costly mistakes, pay more in taxes than you want to. And you want to be in a position where you can keep more of your own money. So, what we always do when we do these workshops, we offer what we call a mini consultation. There's two purposes of a mini consultation. If you've just got a couple of questions and you want to talk to an expert about them, and that's all you need, sign up for a mini consultation. I'm happy to spend a few minutes with you and answer your questions. Second reason people like to have a mini consultation is because they're looking for someone to help them with this complex planning that they need. And I am a certified financial planner and a certified financial fiduciary. And we have a focus on retirement income planning and holistic planning that integrates taxation into it. So if you're interested in learning more about us and if maybe working with us could create a powerful positive impact in your life, schedule one of these mini consultations. Um, they can be as quick as 15 minutes. We can do them in a Zoom call. We can do them in person. They're totally free. And we can talk about whatever's on your mind. So Sam's going to make it really easy for you to schedule one of these mini consultations. I hope you take advantage of it. Now, another Medicare potential tax trap I want to talk about has to do with coverage gaps and applying for Medicare at the wrong time, applying late. This can get really tricky, really fast, and it can cost you a lot of money. So I'm going to show you another example. Here we've got Jim and Ann. Jim and Ann are both 68. Jim retired at 65. Ann retired a year later at 66. They got their health insurance coverage through Ann's employer. This is a really important key, okay? And my first question is, I want you to really think about this. At what age should they have enrolled in Medicare Part A? What do you think? Write it down. Do you think you got the right answer? And the key things to keep in mind, one key thing is they're getting their health insurance through Ann's employer, right? And Ann doesn't retire till she's 66. So some of you might think that the right time for them to apply for Medicare Part A is after Ann retires, but that's wrong. Okay. That can cause big, big problems. No matter, even if you're getting your health insurance and even if you're getting your health insurance through your employer, once you're 65 years old, you need to apply for Medicare Part A. If you don't do that, what can happen is if you wind up in the hospital, that's what Medicare Part A charges, your health insurer may not pay because Medicare is what's known as the primary insurer. All right. So if Medicare doesn't pay first, your insurer may refuse to pay at all. You don't want to be in a fight between Medicare and your health insurer. It's just going to be not a lot of fun. So once you're 65 years old, you need to apply for Medicare Part A, even if you're getting your health insurance through your employer. Now, what about Medicare Part B? When should they have applied for Medicare Part B? Yeah. The answer is they should have applied for Medicare Part B as soon as Ann retired. But they didn't do that. For whatever reason, they missed that. They didn't do that. And this happens to people, unfortunately. And if you miss the enrollment period, which is within 3 months of retiring, if you're retiring after 65 and we're getting your Medicare through your employer, your health insurance through your employer, you cannot get coverage instantly. And what's going to happen is you're going to pay a 10% penalty on the base premium once you do apply for Medicare for the rest of your life. Okay. For the rest of your life. So this could add up to $420 a year for this couple. And as your premiums increase, so does the penalty because it's a percent as the penalty. So over their lifetime, this could be a $10,000 mistake they made. So it's really important to watch for gaps in coverage because it can be really, really expensive. So key three, that's it for Medicare and for Social Security. Now I want to look at key three, which is, we talked about ERISA, right? You've got those ERISA accounts like a 401k, an IRA. ERISA started in 74. In 98, I think it was, Roth IRAs became available. So some of you have Roths, some of you have tax deferred accounts, and we've got after tax accounts, maybe brokerage accounts or bank accounts. So what we want to do is we want to make sure once we retire that we're taking money out of these accounts in the most tax efficient way, right? We want to pay as little tax as we possibly can. So here's an example. If we got Sam and Mary and their goal is to spend $8,500 a month, they could choose from these five different accounts where to get their money from. So what do you think? What do you think is the most tax efficient way to spend this money? It's lots of different combinations. So conventional wisdom, what it says is spend the taxable money first, right? The bank money first. And if you spend the bank money, you're not paying any tax on that, right? You're not paying any tax on it you wouldn't have paid if you just left it in the bank. It's after tax money. So if you retire and all you're living on is your bank money, that's it. You really got no tax. And then after you run out of bank money, the conventional wisdom says spend down the IRAs. When you spend down the IRAs, the money you take out of the IRAs is taxable. So you would go from no tax to some amount of tax. And the conventional wisdom says spend the Roth money, the tax exempt money last. You know why they suggest that? That's because it's really an efficient way to leave money to the next generation. Because when your kids inherit this money, they never pay any taxes on it. So this is one way to do it. This is what's been thought of as conventional wisdom. But there's a lot of people who spend a lot of time thinking about the best ways to do this, the most tax efficient ways to do this, and another way to do this. And by the way, no one way is right for all of you. Okay. So conventional wisdom, that might be appropriate for some of you. And for some of you, this alternate approach might be better. The alternate approach also starts with spending the taxable money first, the bank account money first. But what this alternate approach says is while you're living on your bank money and your income is real low, do Roth conversions. Take money out of your pre-tax IRAs and convert it to Roth. Yes, this is going to create some taxable income in the years you do the conversions, but it's also going to create tax diversification for you so that in the future, you're going to have these buckets of tax-free money that you've got access to for yourself, or you can leave them to your kids or your other loved ones, totally tax-free. After Roth conversions, they suggest spending down the tax deferred money until it's gone. And then finally, spending the tax exempt money, the Roth money last. So again, this is another way to look at it. But your own unique situation is really important because different people have different things going on and nothing's just that simple. And this is really important as you're thinking about taxes in retirement. Just because something worked one way for your friends or your relatives and it worked great for them doesn't mean it's the right way for you. The laws keep changing. If you do what someone a little bit older than you did and think you're going to get the same results, you might be right, but you might be wrong and you might pay big penalties. One good example is required minimum distributions. It wasn't too long ago, required minimum distributions were 72 years old. So if you've got a friend or a relative who's telling you you got to start doing required distributions at 72, they could be wrong. It was right for them, but wrong for you. Might be 75 for you. So that's just one small way things can go sideways, these unintended consequences. So let's talk about Roth IRA conversions. These can be really beneficial for some people, and for other people, they're nowhere near as beneficial. So again, it depends on your unique situation. But the way an IRA, a Roth conversion works is You take money out of your traditional IRA or maybe out of your 401k or out of your 403b and you convert it into a Roth. And the consequence to that is the money you convert, you're going to have to pay tax on in the year you do the conversion. So you got to figure out a way to make sure that happens. Otherwise, you're going to have penalties and fees that you don't want to have. But you do the conversion, and then you've got money now growing in a Roth IRA, which can be really, really powerful. And let me show you one strategy we use because, how much is the right amount to convert? There is no right or wrong amount. It's more about what's appropriate for you, what feels right to you, what's going to defuse that ticking tax time bomb best for you and your family. So here, what we got here is I'm going to show you an example. We got Jill. She's got $100,000, or she wants to convert $100,000 from her IRA to her Roth. Jim's at, or Jim, Jill is at the top of the 22% bracket. Okay. And the top of the 22% bracket is $206,000 in 2025. I'm sorry. She's not at the top. That is the top of the 22% bracket. Okay. $206,000. Jill has income of about $100,000. And if she does a $100,000 Roth conversion, it's going to put her at about $200,000. Okay, so all that will be taxed at her tax bracket. So here's a better illustration. She's in the 22% bracket, but she's not at the top. So filling up the bracket when you do Roth conversions, doing conversions that take you up to the top of the 22% bracket, but not higher, that's one way to think about how much is an appropriate Roth conversion for you. Now, having said this, what I would suggest to you is another way to look at this has to do with Medicare brackets. Because if you go over the 22% bracket a little bit, it's not a big deal. If you go over by $1,000, that last $1,000 is taxed at 24%. But that's it. Remember what happens with the Irma Cliff? You go over by just a little bit, now your Medicare premiums can be substantially higher for a year. So you got to be really careful about these things. And whether or not Roth conversions, do they make sense? Are they going to make your situation better? There's a lot of things to consider. So we put together this illustration for the people we work with, not to tell them whether it's right or wrong, but to give them some ideas to think about. Does the cost, if the cost is high to do Roth conversions, and it is, do we feel like the benefit is equally high or greater? So this is something you're going to need to figure out with your own family. For the people we work with, we help them walk through this. Now, when should you do Roth conversions? Low income years are great times to do this. So if you think back to our example of spending bank money first, I've got people who've retired and they can push off claiming Social Security for a while. And because they've been planning early, they've got money in after-tax accounts. So they're able to live off bank accounts for a few years. So they've essentially got zero tax. Okay. Think about this. Zero taxable income. And the standard deduction today is somewhere around $30,000. So if you're generating $30,000 in tax and you've got no other income, $30,000 in tax by doing Roth conversions, it's going to get basically wiped out by the standard deduction. So low income years can be really good. Thinking this through, having a written plan can be really important, really beneficial for you. If you're a business owner, there's some different times can be really good for you. Like during COVID, that was good for a lot of people, kind of a backhanded way, because maybe sales were down. Also times if you've got high expenses as a business owner, you're going to have more write-offs. That might be a good time to do this. So other possible approaches to managing tax and retirement. Well, we've already kind of talked about this. Oh, some people, not a lot of people I really run into anymore, but some people have highly appreciated stock. And that's another way you can generate cash flow in retirement that can be beneficial because for most of us, even though the highest tax bracket for capital gains is 20%, for most of us, our incomes are low enough where we're in the 15% bracket. Some of you might even be in the 0% bracket. So that's another way you can create cash flow in retirement. All right. But at a certain age, as we've talked about, you've got no choice. You got to start taking money out of your IRAs. And this is when RMDs start, right? So you've got no choice. You got to take money out of your IRAs and your 401ks. But if you're charitably minded, there is a way you can reduce or maybe eliminate these taxes as well. So let me walk you through an example about that. Here we got Albert and Shirley. They're in the 24% bracket, and they want to give $5,000 to a charity. Now, again, this only works if you're willing to give money to a charity, but a lot of people are giving money to their churches and other things. So this works. Now, they've got $15,000 in itemized deductions, but the standard deduction is $33,200. So 15,000, you're not going to take the standard deduction, right? You're not going to itemize because the standard deduction is bigger. So even though they're given $5,000 in a donation that qualifies as a charitable gift, you don't get the benefit of that. You don't get the tax deduction because you got to itemize in order to get the deduction, and you're already getting the $33,200. So it doesn't work. It used to work years ago, but because the standard deduction has gotten so big, it doesn't work anymore. But there's something called a qualified charitable distribution that you can use that can help you. Now, this does not start at your required minimum distribution age. Remember, I said that's 73 or 75, depending on when you're born. It's set at 70 and a half because that's where RMDs used to be. Used to be everyone started RMDs at 70 and a half. And because of a quirk in the way the taxes were written, qualified charitable distributions are still fixed to that old number. Now, each of you, if you're married, can give $100,000 a year out of an IRA once you're 70 and a half, and it qualifies it as a charitable distribution. Okay. So as a couple, you could give away $200,000 a year. Most of you probably aren't going to do that. That's a lot of money. Here's one of the key factors. If you get this wrong, it's not going to work. The money must go directly to the charity from the custodian of your IRA. So if your IRA is held with Fidelity, Fidelity does not send a check to you that you put in your bank account and then send a check to the charity. Fidelity has to send a check directly to your charity. Now, this does count as your required minimum distribution, but because you're doing a qualified charitable distribution, it doesn't count. It's not reported as income. And if it's not reported as income, it's not taxed. Okay? No deduction on income tax return. Now, this is what a non-qualified charitable distribution looks like. The charity still gets $5,000. The money comes out of the IRA, it goes into your checking account, then it goes to the charity. So you satisfy, the charity gets $5,000 because $5,000 came out of your IRA into your checking account. It satisfies your required minimum distribution. You're still writing a check to the charity and giving them their $5,000. So the charity gets their money, but you've got to pay tax on the $5,000 distribution. And at the 24% bracket, it costs you $1,200. So what's the total cost of the charitable gift? It's the tax on the RMD plus the taxable gift, $6,200. You're out $6,200. And you could have done a qualified charitable distribution, taken the money out of your IRA, your RMD is satisfied, and it's excluded from taxable income because the money went directly from the IRA to the charity. Okay, that is the key. So now what's the total cost? It's $5,000, and you don't pay the $1,200 on the tax because that's waived because you did a qualified charitable distribution. Make sense? Maybe a little complicated. It is a lot going on, isn't it? It's a lot to think about. And it's not just taxes in retirement. There's all kinds of other things we gotta get into alignment. We gotta make sure we're addressing all these different challenges and concerns, such as retirement income planning. We talked about this a little bit. Where is the income going to come from? Yes, it'll come from IRAs, bank accounts, and Roth IRAs, but it's also going to come from Social Security. Uh, and you want to make sure you're able to maximize your Social Security. You want to make sure you can keep up with inflation. Number one fear people have as they retire is running out of money. And it's not necessarily because people don't have enough money, it's just they don't know. So it's really nice to have a written plan so you can see what the future looks like, so you know how much you can spend and how much you can't. You want to know this so you can feel good about your retirement. You can feel good about your spending. You've worked hard, you played by the rules, you've saved some money. You owe it to yourself to figure out how much can you spend in retirement and do all the things you want to do. And required minimum distributions, it's like a roulette wheel where they're changing the rules and the laws every couple of years. This stuff can be really, really confusing. So you need to have a well thought out plan. It helps you avoid costly mistakes, pay less in taxes, and keep more of your own money. And it can really be a powerful way to take care of yourself and your family. Let me show you an example. Here we've got Dan and Elaine. Dan and Elaine are real clients of mine. When I met them, they had $150,000 in Roth IRAs. And, they had more money in regular IRAs and 401ks. And as part of the planning we did together, we looked at Roth conversions, and they felt like Roth conversions made a lot of sense for them. So what they decided to do is they decided to convert $30,000 a year for 10 years, okay, into Roth. So over 10 years, they were going to convert $300,000. So if we add 300,000 to the 150, they're going to have $450,000 after 10 years go by. And let's say this, there's something called the rule of 72. And what the rule of 72 says is whatever growth rate you divide into 72, it tells you how long it takes to double. So if they could just get a 7% rate of return on their investments, they would double their money every 10 years. Okay. So it could be that they could double their money twice before they passed away and left the money to their sons. Okay. Two boys they had. So if they can double that money twice, 450 is going to turn into what? $900,000, which will turn into $1.8 million. And that money is all totally tax-free. If they wanted to take money out over that 20-year period, they could. No. In fact, this couple did. They wanted to buy a new house, and they took a big chunk of money out of their Roth IRAs to buy a new house down in Florida. But anyway, let's stick to this example where they don't buy the house. So by the end of their life, the $450,000 they put into Roth could potentially be worth $1.8 million. And now, when their sons inherit this money, each would inherit half of it, so they'd each get $900,000. And even with the new stretch rules, they don't have to take any money out for 10 years. They can leave it in Roth for 10 years. And if they can leave it in Roth for 10 years and the sons can get 7% interest, each son could double the $900,000 he got to give each son $1.8 million, totally tax-free. That is the kind of power you can harness when you're taking the time to create a written plan and consider things like Roth conversions. Now, one more thing I want to share with you. I want to tell you a story about the harbor pilot. And the reason I want to talk about a harbor pilot is because investing is a journey, much like a cargo ship has when it leaves China and comes to California. Okay? Investing takes a lot of hard work. It takes discipline. It takes skill. And, when we got started, remember, we had nothing. It kind of looked like this if we're maintaining our maritime analogy, right? Very, very small, really didn't have anything. But hopefully, as time has gone by, this is what our investment portfolio looks like today, right? Looks more like one of these cargo ships. And as you reach retirement, You need to hire a harbor pilot. Sailing across the ocean is relatively simple, but going into the harbor is where it really gets treacherous. You need a trained professional, a professional who's got one job, and that's to get the ship into port safely. And the reasons you need a harbor pilot as you get closer to retirement are you got more to protect. The skills are very different. Once you get close to retirement and you're retired and you're drawing income out of your investments, you need to work with someone who's got to focus on retirement income planning and on tax integration. Investing prior to retirement is really pretty easy. But once you get close here, all the different tax traps we talked about, they come into play. So the risks are greater. And if you make one mistake, it can really sink your ship. And as I said, most of the time when we were in the accumulation phase, it's been pretty easy, right? It's just every once in a while, there's these really scary things that pop up. So, they're like terrible storms. Like, remember when the tech bubble burst and the NASDAQ collapsed? It's pretty scary. And then after that was 9/11. That was a big iceberg. And then we went to war in Afghanistan and Iraq. We don't got to worry about pirates and giant squids, but we did have the financial crisis, right? And then we had COVID, and then we had a recession after we recovered from COVID. So you got to be ready when you're drawing money out of your investments. How are you going to get them out of your investments when things like this are going on? And really, I want you to think about this. Most of the time, investing is easy when you're in the accumulation phase. In fact, if you had been able to invest $50,000 in 1983 and just left the money alone, if you invested it in the S&P 500, it'd be worth over 3.3 million today. How many of you would be worried about your retirement if you had 3.3 million today? Not many of you, right? So what happens is once we get close to retirement, once you're in the harbor, things are much more treacherous and much more dangerous. And there's something else waiting for you in the harbor. You know what it is? It's your silent partner. You know who it is. It's why you're here today. It's the IRS, right? Yeah, your IRS is waiting in the harbor. We've got a $38 trillion debt. And then collectively, we've got $40 trillion in ERISA investments. It could be the government needs that money to make things work. And the IRS is there, is not there anymore. Your greatest partner is left. You know who it is. It's time, right? Time used to be on our side when we were young. We never had to worry. When the financial crisis came in 2008 and 9, it was scary, but we knew things were going to recover and get back on track. But now time's not on our side anymore. You don't have time to keep your portfolio growing. You don't have time to absorb market corrections or recover from bad decisions. And that's why you need a harbor pilot. You need a harbor pilot for your investments. And that's why I hope you'll consider working with us, because that's what we do. We focus on retirement income planning. We've got all kinds of sophisticated tools and strategies we use, techniques. We have special training, and we use a holistic approach that integrates tax planning into your investment planning. So what we want to do is we want to get you home safe. And if this appeals to you, or if you just got a couple of questions we can answer in 15 or 30 minutes, please go ahead, set up one of these mini consultations, totally free. You can ask whatever questions are on your mind. Here's plenty of questions that get asked. So there's no question that's too silly. Whatever questions you've got, I'd love to be able to help you answer them. So that's a lot. That's who we are. That's what we do. I hope you found this useful. Hope you found it interesting and informative. Let us know if you're interested in the mini consultation. And if you are, Sam will get back in touch with you to schedule a time and a day. So thanks a lot, everybody. I appreciate your time. I appreciate your attention. It was nice seeing y'all. Hope you have a great day, and I'll talk to you another time. So long.